Hello there. It's me, Stephen Thomas, with another housing debrief. I want to thank you so much for joining us. Uh, what we're talking about today is a little bit to do with inflation. We have sticky inflation is hurting housing. And I'll explain exactly what's going on. It all has to do with kind of what we talked about last week in our last week's episode of the housing debrief. Anytime we have interest rates higher than 7%, it really slows down the housing market for a myriad of different reasons. Number one, psychological factor. 7% plus psychologically, it's just too much for homeowners to come on the market, and it's too much for buyers to participate. It doesn't mean that it's void of all real estate activity. It just means we can see a slowdown in the overall data, that there's a change in the data when we have interest rates that stick above 7% with any kind of duration. So without further ado, we're going to get into this, and we're talking about CPI. CPI, of course, came out yesterday, and it was a big giant, way above expectations by zero point 0.1. So they had expectations that that it was supposed to be a certain level, and it was a little bit higher than what they originally thought. And we're talking about core CPI is at 3.8%. You can actually see it rose very, very slightly, and exceeded the expectations, like I said, by a very small percentage. And so did headline CPI went up. A lot of that has to do with fuel. Fuel has, if you've gone to the gas pumps recently, you've seen a problem with it's a little more expensive than it was last week. And that last week was a little more expensive than the week prior. So it's been climbing up higher and higher. So that's kind of part of what the reason for CPI's big reading being out of bounds. Another reason for it has a lot to do with the underlying mechanics. When you look at it, housing actually went up for the month. So from month to month, it went up. It's a weird statistic. I don't like to even get into it. It's called owner's equivalent rent. I will not discuss it here at this time, but just know that it came in a little bit hotter. So you have fuel, and then you also have housing as big key components. There are other parts of this that have been that have been spiking. One of them, I'm sure that you've had your if you've looked at automobile insurance, like insurance here in California, has been skyrocketing, but automobile insurance across the United States has had a problem. So, and that is all has to do with that basket of goods consumer price index. And that's one of the ways that they actually gauge inflation. It's not my favorite, and it's definitely not the Fed's favorite, but unfortunately, this is the one metric that really gets the equity markets moving. A lot of equity markets turn to it to take a look at, okay, where are we at today? And they wait for CPI. CPI comes typically before can't even say it, PCE, which is actually next week. But if you look at the consumer price index, I showed you how from month to month on this, that if you see those purple circled dots in that last 12 months, you'll see how from February to March, there was a slight rise, and that slight rise was by 0.1. And that was that change where it was just enough where it was out of bounds, and it created a lot of friction in the equity market. And if you look at, that last one looked all the way back since they tracked inflation. This just goes back to 2000. And when you look at 2000, you can actually see the slight little bump in consumer price index. And this has a lot to do with that OEM, like I talked about, the owner's equivalent or owner's equivalent rent. And it also has a bit to do with the gas, but not the core. I'm pointing to core here. That pulls out the volatility of gas and fuel. And unfortunately, it's just been a bit sticky. It's made it sound like that they're going to have a hard time getting inflation down to their 2% target. So this is where everybody's coming in and saying, there's a real stickiness to inflation. It's going to take a real long time to get this down to their 2% target. So they're not going to be able to reduce rates as often as the Fed originally had thought. Now, King Cash has been sitting on the sidelines, and they're waiting to pounce on the market as soon as everything cools down. Or on the opposite side of the fence, they're actually not playing at all in the in longer term issuance because there's not a lot of risk in the current marketplace. So when you have the overall economy doing what it's doing, this is where we're at. So there's this love affair between treasury bonds and mortgage-backed securities. That investor that's out there actually is looking at both that cash investor of 10-year treasuries as well as mortgage-backed securities. And when you look at the 10-year treasuries and mortgage-backed securities, they typically go hand in hand. As the economy heats up and is too hot with the different readings and exceeds expectations, kind of like what we've had so far this year, that's where we see rates climb. So we started off the year at about 6.5%. And slowly but surely, we've been climbing higher and higher as the year has progressed. But the opposite is when you get a break in the data where something is really starting to come down, it's no longer going up, and things are slowing, that's where you're going to see rates fall. And we've seen that in the past. We saw it for a minute. That was in mid-December, but we'll get into that. So the 10-year treasury, this is where 10-year treasuries are as of this morning. I'm doing this on the Thursday, April 11th. And at 4.55%, this is a lot higher than where it was at the very, very start of actually 2 days ago, because yesterday was the big push up, and that was with the release of CPI. And you could see what a big, giant change it's been. We're at 4.55%. It's gone all the way from where it bottomed out in December, slowly but surely has been rising. You could see how it's not been a straight up and down. There's been times where it has come down, but this is yesterday. Yesterday, we had this giant climb in the 10-year treasury, and it has everything to do with CPI that was just released. And this, if you look at the last time we were here, was actually, it was at the first half of November. Is where the last time we were at this. We've been higher. You can see that Himalaya on the left. That actually is where we got to 8% interest rates, but this is where the 10-year treasury is. We follow the 10-year treasury to give us a map for the direction of interest rates, because it will tell us a lot more about where the markets are headed and where we think interest rates are headed based upon recent trend lines and activity, because there is an absolute love affair that dates back to early 1970s when they started tracking 30-year mortgages, and the 10-year treasury and 30-year mortgages have kind of gone hand in hand, going all the way back to the start of the 1970s. So when it goes up, the 10-year treasuries, the yield on it, guess what? So do interest rates, and so do mortgage-backed securities. The same thing with when it goes down, the yield on 10-year treasuries, we have interest rates that go down. So I'm going to talk a little bit more about that. But first, I want to bring in our sponsor, and our sponsor is Alan Mack from Mack Financial Services. So Alan has these great relationships. He has private banking rates for your clients, especially right now in these more volatile interest rate times. This is where you tap into somebody like Alan, that you can leverage the relationships that he has. And he is a master on the luxury side. He definitely, that's his wheelhouse, is working with the luxury clients. And he has a network of private and regional banks. He knows the best of the best in these banks. He's a luxury specialist with loan amounts up to $30 million. Like I said, specializing in luxury, shops for the lowest rate, below market interest rates is what he can get your clients. Unique offerings, debt to income ratios up to 50%. Flexible underwriting, and he has special doctor loans where it's 100% LTV up to 1 million, 95% loan to value up to 1.5, and 89.9% up to 2 million. And loads of experience. He's been doing this since 1988 with over 100 5-star reviews. He has unparalleled knowledge. And you can contact Alan Mack at Mack Financial Services and let him get you the lowest rate. and let him work for your luxury clients, or if you're in the luxury market, he can help you out. 949-929-1091. That's 949-929-1091. And now back to the program and the love affair between the 10-year Treasury and mortgage interest rates. And you can actually see this go back in time. I mapped this out, and you could see where the 10-year, that's the blue line, bonds, and 30-year mortgage, there's a spread, but they kind of go together. You can see the red line is the 30-year mortgage rates. I'm only going back to 2015. And there is an average spread going back in time. And the average is actually a 1.712. And that's how much above if you look at this last picture, you could see that the average of that blue line, you can add 1.712, and that gets you to the red line. Typically, that was the average. So whatever the 10-year is, you can add 1.712, and that's where we should be at. Now, where that 1.712 is, I've actually dotted this out. So sometimes it's below the spread, sometimes it's above. And right now, on the very left, you can see that's the Great Recession. On the very right, this is the volatility since interest rates have really skyrocketed in 2022, and inflation became an issue. And you could see that the spread is much larger than what we have been dealing with in the past. You could actually see on the right-hand side that it is coming down. So you could see the slope is on its way down. We're moving slowly but sure in that downward direction. So the spread is getting a little bit better, but it needs to make its way all the way to that orange line. So, which means that this is good news, that even though 10-year treasuries have been really high, interest rates aren't as high as they could be, but they are a lot higher than where they were a couple days ago. That's for sure. But hopefully, slowly but surely, we can see this trend of the spread coming more and more back to normal, and that is when we have a little bit less volatility. So we'll have to see where it goes from here. Now, as far as interest rates are concerned, we're at 7.37% interest rates as of today, April 11th, 2024, and you could see that we're stuck above 7%, and that is where we really have a slowdown in the overall real estate market. You don't feel it. If you're in the entry-level price ranges, you absolutely don't feel it, but there is a change in the data, and I'll show you that in a second. But you could see how from December, very similar to the 10-year Treasury, it fell like crazy, and that big giant drop in December was because the Federal Reserve changed their language and became a little bit more dovish, a little softer in their language, and all of a sudden interest rates really dove. So did 10-year Treasuries, but the overall data points since then have been a lot stronger than expected. The interest rates were bouncing around 7% until yesterday. And yesterday was the big giant change. And that's where you could see interest rates climbed more than 0.25% in one day, which is extremely volatile. You're not used to seeing these gigantic gyrations, but the economy was done with, the equity market, they were done with it. All the investors, they said, that looks like there's one interest rate fewer that we're going to have this year. And as a result, you could see where interest rates are at. They're more towards the end of November rather than the start of November, the first half of November. The second half of November is where interest rates are today. And that's because the spread got a little better so far this year. But still, you could see the last time we had interest rates this high dates back to November. So what everybody feels out there is we're going to go from 3 rate cuts now to 2. And it looks like, unless there's some changes in the data, that first rate cut is not going to happen, not in May, not in June, but it's not going to be until later on in the year. And some are even saying that it doesn't look like it's going to be till September is when they get the first rate cut. So we'll go from 3 to 2. But that's where everything's pricing based upon what everybody's seeing today. And that's because the myriad of different data points that have been exceeding expectations, which means the United States economy is a bit hotter than what everybody expects. And as a result, we've seen interest rates push up higher, as well as the 10-year yields push up higher. So now we're looking at 2 versus 3 rate cuts. And so everybody's carefully watching what they think the Fed is going going to do based upon all the data and listening carefully to everything the Fed is stating, because what's happening now is we have interest rates that are floating a lot higher. And so what's happened with that is we have kind of the housing market has been frozen. It was thawing a little bit with interest rates close to 6.5%. We actually saw that year-over-year gains in pending sales and closed sales, and values were going up because it was hotter, because we had interest rates that were below 7% at the start of the year. But once we get above 7%, it kind of like freezes, it kind of gums up the housing market. And so I'm just going to show you where we are within the last 2 weeks. Because of what's just happened, we saw a big spike in the inventory, pretty much actually in just the last week. We saw the inventory jump up 6%. And then what we saw in demand, which is just a snapshot of pending sales activity, went down 6%. And if you look carefully enough, that's not normal for spring. That's not normal at all. So what you're seeing right here is it's coming down right now, which is a leg down, contrary to last year when it was going up. So what's happened also is the expected market time, that's you place your home on the market, when are you going to become a pending sale, has increased by a week. And that just happened within the last week. So it's slowed. That's also not normal. What we're used to seeing is that slowly but surely, the expected market time kind of stays the same. It can slow down a little bit. It did in 2018. And that's why the 3-year average, which is the green line, is actually goes up for the remainder of the year. But that has everything to do with 2018, when we had interest rates that rose all the way to 5% back then. But 2017, 2019, kind of flat, very similar to that 2021 red line, just higher. But you can see this, the purple line, that's this year, went up. So it's now takes an extra week to absorb the inventory at the current pace of pending sales. And so the spring market, this is contrary to the spring market. The spring market is typically when we have a rise in inventory, but we have a similar rise in demand, and demand tends to peak sometime between April and May, but it's not this big sharp change. That's not what we see, where we saw inventory sharply go up and demand sharply go down. It typically peaks and then slowly goes down. It's not a giant decrease. So what we're seeing is more a reaction to interest rates at above 7% with duration, and now well above the 7% threshold. So when you have this gummed up frozen housing market, that's where, as long as interest rates are above 7% with duration, there will be fewer homes coming on the market, because homeowners will go, you know what, I'm enjoying my low fixed rate. In the 7s, that's a little bit too high. We'll still have more people that are coming on the market because they're tired of waiting, but this will slow that down a little bit because of interest rates above 7. And then we'll have fewer pending sales as a result, fewer closed sales during this time period where interest rates remain above 7%, and the values will be flat. And we kind of saw that the second half of 2023 last year, where interest rates remained above 7% from the end of July all the way to the second week of December. So pretty much 5 months of interest rates that were sticky above 7%. So the big thing is once we get back down into the 6s, there will be that will free up. It'll thaw out the market. It will make it ungummed, and you'll see interest rates actually come down a little bit, because there are economic headwinds out there. We've talked about them before. A lot of it has to do with personal savings rates and credit card debt and automobile debt and things like that are this economic headwinds, where eventually it's gonna slow up the economy enough. And exactly when that's gonna happen is anybody's guess. Everybody's guess was it was supposed to be sooner. My guess was about between spring and summer is where we're gonna start to see that happening. Haven't seen it yet, but that's where we should be able to see it, is sometime between the spring and summer. There's an off chance that it even happens the fall on, and there are many people that are now jumping over to that camp, but that's what everybody does. Everybody tends to over-exaggerate the data points. They look at a data point. I know that we've had several of them getting up to where we are in April, but like I said, I didn't anticipate even seeing any real slowdown in the numbers until we got to spring or summer, and here we are. We're in spring and summer, so it can happen at any time, but everybody's over exaggerating, watching every data point because they're worried of what the Fed will do, because the data is very, very important. The Fed has said they're watching every data point. They're actually spending so much time looking at data points, which is looking in the rearview mirror, that they're not doing enough preventative defense for what's going to happen in the future. So what they're relying on is they want to know specifically that it is definitely happening. And as a result, what will happen is they're going to wait longer to make a change when they definitively see something slowing it down in the data. Let it be inflation, but ultimately they could cause a recession along the way if they wait too long. And that's what they're kind of worried about, but they're not too worried about causing a small recession because they have the necessary tools to fix it. And what are those tools? That would be to stop their balance sheets from draining. And that's one of the things they're doing. And the other one would be to lower rates. So we're watching all economic calendars. I think everybody should be watching economic calendars. You can go to fxstreet.com, just toggle just the United States to see all the different data points that everybody's looking at. And everything is making a difference. But the most important one that's coming up is the one that the Fed cares about the most. And that's actually making its way closer to the 2% target. And this is a way better. I like PCE way better than CPI. But unfortunately, everybody likes CPI because it comes first. But this is the one that the Fed actually likes. And you could see those purple big circles in the last 24 months. And you could see what's happened over the last couple of months. And that's where the core PCE continues to go down. That's once again pulling out the volatility of food and fuel. So this will be more interesting to watch. And this one comes out next week. So super important. So watch that to see where our market's headed, but this is where it's at right now. It's kind of gummed up, kind of frozen. Hopefully PC will be more cooperative than CPI, and we'll see where that takes us next week. And if you like the content that you're seeing, so you can make good decisions for yourselves, good adult decisions for yourselves, for your clients, this is what this channel is all about. It's about properly setting expectations for buyers, for sellers, for anybody tied to the real estate industry, so they understand what's going on, so they can articulate what's going on, so they can just make really good decisions based upon properly set expectations, not a narrative. So like the channel, subscribe to the channel. If you like what you're seeing, go to reportsonhousing.com, subscribe to one of our many housing reports. We have Bay Area, all throughout Southern California, report for each county, and then we're going to be hitting Vegas as well as Phoenix coming up next month. And the most recent one that came out is called the temperature of the market. And if you're along the coast, that would be San Diego, Orange County, LA, Ventura. You're getting a new report next week. If you like what you're seeing, subscribe. The coupon code is CPI because that's what we just talked about today, is CPI. So go to reportsonhousing.com, enter CPI for a free month. And so once again, I just want to thank you for joining us for another housing debrief. We're going to be bringing you the latest and greatest of what we're seeing in the marketplace on a weekly basis. And I hope you have a great finish to your week, and we will see you on the other side.